IFRS 19 subsidiaries without public accounting. It's a short standard. We'll try to finish it very quickly. What we understand from here that number one, this is a standard which is applicable only to subsidiaries, and number two, that it is only about the disclosure requirements. So it has got nothing to do with the recognition or measurement principles. It is only focusing on the disclosure requirements, especially for subsidiaries. Now, let me just give you a little bit of background about disclosures. Now, if we go back some, 25, 30 years, so there were at that time, there was a concern by the accountants and auditors that the primary financial statements, the income statement, balance sheet, and so on, they did not provide sufficient information to understand and interpret the financial statements, and therefore, businesses should provide sufficient disclosures. The disclosures about the accounting policies, disclosure about how did they calculate different numbers, how did they apply different standards, and so on and so forth. And that was a concern by auditors as well. Okay, so the purpose was to provide detailed information, like all that information which otherwise we could not have provided in profit and loss account or in the statement of financial position. We should put that information into disclosures. So that was a requirement to bring more disclosures. Now, to achieve this requirement, what happened that over a period of time, businesses, they started giving disclosures and they started giving too many disclosures. And a time came, maybe probably few years ago, everybody started feeling that now the information which is provided, it is too much. So we said that give us more information, but then they start giving us so much information that sometimes, the important idea is lost. And of course, there is cost, there is time to provide all those disclosures. And I think that we can say that safely that for the last 5-6 years, another debate started that do we really need so many disclosures or not? Or can we, limit or cut down the disclosures? Because we said that we need more information, but now that is too much. So now the recent development was that we started thinking about that how much or how many disclosures or how much information within those disclosures do we really need to call them, a complete set of financial statements. So this is the idea. Now, to formalize this thing and to how to say simplify the things, we said that IFRS 19, which says that those subsidiaries which are okay, by the way, I'm going to discuss the details of the standard probably in next 20 minutes, but bottom line is very simple. The bottom line is, which if you understand it right from the beginning and then we can go into details, the bottom line is that there is a group where there is a parent and the parent is producing consolidated financial statements and the parent is providing all the disclosures what are needed. Subsidiaries, the subsidiaries who are not listed companies by themselves, they have this relaxation of not providing so much detailed disclosures. So it is like simplifying the job for the subsidiaries who are not listed companies, who are not listed on stock exchange. They are not publicly traded companies. So for them, there is a relaxation on the disclosure part only. Otherwise, they will apply the full IFRS. Remember, don't mix up with IFRS for SMEs. IFRS for SMEs is a simplified version of IFRS. That is a different thing. We are not talking about IFRS for SMEs, okay? We are talking about IFRS 19, which means that those subsidiaries, they will apply the full IFRS. The full IFRS, not the SME. The full IFRS they will apply as far as measurement and recognition things are concerned. But when it will come to providing the disclosure notes, they have been given some relaxation. And the purpose is to not to provide repetitive or unnecessary information, because the parent in any case is going to provide the information and it will save time, it will save cost, and it will balance the information which is given. Now, this is the background and this is the objective of the standard. As you can see that effective date is 1st January 2027. Early application is permitted. Whenever you see effective date 1st January 2027. It means that if you have to prepare it, for example, so 31st December 2027 is the end of the year. So your first financial statements where you will introduce IFRS 19 probably would be 31st December 2027. But the transition is always done the beginning of the prior period. We call it the beginning of the prior period, which means 1st January 2026. Okay, so objective IFRS 19 provides reduced disclosure requirements for eligible subsidiaries. So, number one, it is for subsidiaries, and number two, it has to be eligible. Now, what is the eligibility criteria? Primarily, the focus is on that they are not publicly accountable firms, which means that they don't have debt equity on, the capital markets. They are not publicly traded, and they are not financial institutions, by the way. So the goal is to ease the reporting burden while maintaining transparency and comparability. IFRS 19 allows some subsidiaries, not all, some, because those who are not publicly accountable, to apply IFRS accounting standards with reduced disclosure requirements in their individual financial statements, because consolidated, in any case, parent will do in their individual financial statements, and subsidiary will need to disclose application. And this is very important, that subsidiary needs to disclose that they are applying IFRS 19, which means that they are going for reduced disclosures. Reduced disclosure requirements are expected to balance information needs of users of eligible subsidiaries. What are eligible subsidiaries? I have told you, which are not publicly accountable, and we will discuss in detail. So, of users of eligible subsidiaries financial statement with cost savings for preparers, because it will save a lot of time. Remember, disclosure notes are very long, by the way. If you see a set of financial statements where you've got 100 pages of financial statements, so one page it goes for profit and loss, one page goes to statement of financial position, one page goes for equity, one page goes to cash flows, 496 are disclosures. So disclosures traditionally have been a huge work. So now they are trying to reduce that thing, okay? Imagine 4 versus 96. This kind of thing you can have in mind. Okay, IFRS 19 application is voluntary. So it's not, number one thing you need to understand, it's voluntary. So it means that the subsidiaries, they might decide that we are not adopting IFRS 19 and we are going for full disclosures. They can do that. So entity can apply or revoke IFRS 19 at any time except with extreme fluctuations. Criteria: entity is a subsidiary, and it will be applied in individual financial statements. And entity does not have public accountability, which means that their debt or equity instruments are not publicly traded. So it's not a listed company, okay? You can see like this that it is not a listed company. And it makes sense. If it is not a listed company, why should it be disclosing so much information there? And entity has a parent, which means that there will be a parent who will produce a consolidated financial statement and all the disclosures will be provided there. So the parent will take the pain. No public accountability, that is not a publicly traded entity and not a financial institution, so financial institution, even if they are not publicly traded, still they cannot adopt IFRS 19. So IFRS 19, so they are excluded. An intermediate parent company is also eligible to IFRS 19. Sometimes you have intermediate parent, which means that, X company is owned by Y company is owned by Z. So Y is an intermediate parent because Y also has an ultimate parent above. So intermediate parent can also apply it. So imagine that you've got a tree here where you've got a parent which owns a subsidiary S1, and then a subsidiary S1, it owns S2. So this one, S1, is actually an intermediary. We call it intermediate parent because this is a parent for S2, but S1 itself is owned by P1. So this is exempted and this is exempted from disclosure. They can apply IFRS 19. They can also apply IFRS 19. Okay, then Main features of IFRS 19: recognition and measurement. So IFRS 19 is not about recognition measurement. You will keep on applying your standards, whatever you have: leases IFRS 16, financial instruments IFRS 9, revenue IFRS 15, PPE IS 16. All those standards will be applied in the same way as you were applying them before. So there is no change in them. So subsidiaries apply full IFRS recognition and measurement. Only disclosure requirements are reduced, not the accounting treatment. Reduced disclosures based on full IFRS. Remember, I'm using the word here, full IFRS. So this is actually not like wording from my mouth, full IFRS, but that's a technical, I mean, that's a terminology. Because remember that you do have another set of standards, we call it IFRS for SMEs. So one we have IFRS and one we have IFRS for SMEs. Of course, SME means small and medium sized enterprises. So this is actually called full IFRS. And this is what we have been studying, what we have been teaching, what we have been learning. So whatever, I mean, if I taught you IFRS 9 or IFRS 16 or IFRS 15 or IS 37, all of that is this IFRS, which is called full IFRS. IFRS for SMEs, it does not have any other standards. It has the same standards. Like you've got IAS 40 here, you've got IAS 40 here, the same standard. The only thing is that here you have some relaxed conditions. Here you have some simplified accounting treatment. So the standard name is same, standard concept is same, only some simplified accounting treatments are adopted in some standards, okay? So that is called IFRS for SMEs. So here we are not talking about IFRS SMEs, we are saying subsidiaries will apply the full IFRS as it is. Only disclosure requirements change. So reduced disclosure mean based on full IFRS, but tailored to be less complex. So you will have disclosures which are based on your full IFRS, but tailored to be less complex and more cost effective. And derived from IFRS for SMEs and other streamlined guidance, which means that it has some resemblance in the form in terms of disclosures, by the way, not in terms of accounting treatment. Because remember, full IFRS and IFRS for SMEs, sometimes accounting treatment could be different. Different in the sense that what is required in IS in full IFRS, it might be relaxed in IFRS for SMEs because we want to make them easy. Okay, in terms of measurements and so on. The disclosure requirements in IFRS 19, only they have been taken from IFRS for SMEs, not the accounting treatment. Accounting treatment will remain as full IFRS. Yes, the simplification of the disclosures is similar to the disclosures which you gave in IFRS for SMEs. This is what it means. Consistency with the parent, it allows better alignment with group accounting policies, making consolidation easier and less costly. Okay, then we have got key disclosure reductions. Examples of areas or IS, one thing you need to understand that there are certain exceptions, like there are some standards for which we cannot reduce the disclosure requirements. And there are some standards whose disclosures where we had very complex and long disclosures, those disclosures will be reduced. For example, of areas or IFRS where significantly reduced disclosures include IFRS 7 financial instruments. So here you have a reduced disclosure requirement for subsidiaries, not for the parent. IFRS 15, very, 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 you know, complex and lengthy disclosures were there. They have been reduced. Leases, impairment IS 36, provision IS 37, fair value measurement IFRS 13. So these are some examples, not all of them, but some examples where the disclosures have been reduced. So we can say that, for the sake of IS 37 provisions, parent might go into full disclosures, but subsidiary can have reduced disclosures for IS 37 application. IS 37 application will remain same. Recognition measurement principles will remain same. Only disclosure requirement will be reduced. exception in IFRS 19, which means those standards in which you cannot have reduced disclosures. You still have to give the disclosures as you were giving before. Okay. So IFRS 19 does not reduce disclosure requirements for IS 33, which is EPS, IFRS 8 operating segments, and IFRS 17 insurance contracts. Here you still need to give full disclosures. Okay. Then we can think like for an example. So, by the way, this is all. That's all about this standard, nothing more. Okay. I'll just show you a comparison with SMEs a little bit. I mean, just in a while, but just see an example. It's very simple. It makes perfect logical sense. Just read it. A large multinational listed on the London Stock Exchange, so that seems to be a parent, prepares consolidated financial statements under full IFRS. Company B is a subsidiary to this company A, which is a wholly owned subsidiary of company A, operating in a country, probably in India. It is not listed and does not hold assets for the public, which means no public accountability. So we can say that company B is entitled to apply IFRS 19 because the company B is a subsidiary, company B is not listed, and company B has a parent who is applying full IFRS. So this is a perfect situation where IFRS 19 will apply. And company B prepares standalone financial statements for local legal and tax reporting, standalone reporting. So what will happen? Before IFRS 19, company B had to follow full IFRS, including all detailed disclosures, even though it is not publicly traded and its financial statements are mainly used by the parent, but still it was required to provide detailed disclosures. And this was time consuming. Now, what will happen? After IFRS 19 comes in, company B continues following full IFRS, the subsidiary company B. They will apply the full IFRS in terms of recognition and measurement, and accounting treatments will remain same as they were before, but it uses reduced disclosures under IFRS 19, such as less detail on financial risk, shorter notes on revenue contracts and lease details, and then simpler information on provisions and fair values. Otherwise, they have to provide information. How did they calculated fair values? Where the provisions came in, and then what was the risk management policy under IFRS 9? If they were using IFRS 9, they were using hedge accounting, so they had to produce a lot of disclosures on that. So now they are gone. Okay, so this is the difference which has been made. Benefits of IFRS 19: cost saving, less complex, encourages uniform accounting and policies across the group, retains key information needed by creditors, lenders, because the parents will be providing disclosures. And finally, transition to IFRS 19. When adopting IFRS 19, subsidiaries must provide transition disclosures that we are adopting IFRS 19 on a certain date. They must also disclose the date of transition. If moving to or from IFRS 19, moving to or from, because it is voluntary, so it is possible that you adopt IFRS 19 and then later at some point in time, based on the shareholders or investors requirement, you might go back and say, no, we have to, although we are not required to provide detailed disclosures, but we want to disclose. So you say, I'm not following IFRS 19, I'm not going to adopt. I will actually, you adopted in past, but now you can leave it. Okay. So that is also a choice. So if you are moving towards IFRS 19 or moving away from IFRS 19, that is also possible. In that case, comparatives may need to be adjusted as per accounting, IS 8 accounting policies. This is the comparison of IFRS and IFRS for SMEs and IFRS 19. See, in IFRS 19, the measurement principles, you will follow the full IFRS. When you measure your, assets or liabilities, the full IFRS, whatever you have learned so far in different accounting standards, you will follow the same method. In IFRS for SMEs, we use the simplified version. So I've got lectures on IFRS 19, IFRS for SMEs. you can go and see that how do we measure provisions? What is the difference in measuring the investment property? Because we've got a different method of simplified versions we have there. Okay. So simplified versions, IFRS for SME. So in terms of measurement, it is full IFRS as before. This is actually for SMEs, which is different. Recognition principle, again, they remain same as full IFRS. And here you have simplified or modified. Disclosure requirement reduced from full IFRS. Here you have reduced and simplified. So this was very simplified. This is something in between the full IFRS, and then you come reduce from there. And applicability, subsidiaries without public accountability. This is applicable to subsidiaries, not individual companies who don't have parents. If you are a small company and you don't have a parent, okay, let's suppose that let's not use the word small company. If you are company A company, okay, you are not listed. You are not listed, but you are not part of a group. You are just one company. Then IFRS for SME is not for you. IFRS for SME is when you are a subsidiary, which means there is a group, and you say, I'm not doing it, my parent will do it. But if you are an standalone individual company, whether you are publicly traded or not publicly traded, you go for the full disclosure. Then IFRS 19 is not for you. Okay. So this is for subsidiaries only without public accountability. And this is small to medium size entities, SMEs. So this is all with IFRS 19, nothing much to say. And actually, I'm a bit more quick on this topic as well. That number one, it's not very really lengthy thing. And number two, the disclosure requirements. In any case, we don't do a lot of work on disclosures for academic purposes. Because for exam purposes in exams, they don't ask you to write down disclosures. You never learned how to write a disclosure. Yeah, you just provide some information that we should be providing this disclosure, but disclosures are not tested for academic purposes in detail. That's why I was quick on this topic.